The price of gold has experienced impressive performance so far in 2024, with increases of 28.1%, 27.2%, and 28.3% in US dollars, euros, and Swiss francs, respectively. Even more notable is the year-on-year increase of 42.3%, 35.0%, and 31.1% recorded at the end of September. In light of these results, the question inevitably arises: has gold reached its ceiling? Are we facing a bubble similar to the early 1980s? Ronnie Stoeferle, managing partner at Incrementum, does not believe we are close to a peak in gold prices, asserting that there are 5 fundamental reasons for prices to continue rising in the coming years. First reason: inflation adjustment. Despite gold surpassing $2,675 per ounce in the market, its inflation-adjusted value has still not reached its historical high. Stoeferle highlights that, although the price of gold has been breaking records since December 2023 in US dollars and since October 2023 in euros, it remains below its inflation-adjusted peak of $2,646 set in January 1980. This detail is crucial as it indicates there is still room for growth in the price of gold, and concerns about a potential significant correction or a bubble are unfounded. Furthermore, Stoeferle emphasizes that the method for calculating inflation has changed significantly since the 1970s. If the calculation method from that era were used, the accumulated inflation over the last 4 decades would be much higher, which would also raise gold's inflation-adjusted historical peak considerably higher than what is currently reported. Second reason: high demand. Another key factor supporting the rise of gold is the high global demand, especially among central banks. While China reduced its pace of gold accumulation in the second quarter of 2024, India significantly increased it, with an 18.7-ton increase in its gold reserves during this period, almost matching Poland, which also boosted its reserves. In the first quarter of 2024, India had bought slightly less, but in total, in the first 6 months of the year, the Reserve Bank of India increased its gold reserves by 4.6%. This increase in central bank gold reserves is a clear signal of the importance placed on gold as a safe haven asset in times of economic and political uncertainty. Another relevant point is the surge in OTC, over-the-counter gold transactions, which increased eightfold in 2023 after a significant drop in 2022. This boom in transactions has continued in 2024, with a nearly 60% increase in the first half of the year, offsetting the 6% decline in gold demand in the second quarter of 2024. These figures suggest that despite some declines in certain demand sectors, activity in the gold market remains robust and is driven by structural factors. Third reason: falling interest rates. A third major driver behind the increase in gold prices is falling interest rates. In September 2024, the U.S. Federal Reserve cut interest rates for the first time since July 2019 amid growing speculation. This cut, which surprised the market by being 0.50 percentage points, marks the beginning of a new cycle of interest rate cuts, which has historically been positive for the price of gold. Stoeferle notes that in each of the 3 previous interest rate cut cycles since 2000, gold experienced significant increases. In the post-dot-com bubble cut cycle, the price of gold rose from $270 to around $420, a nearly 60% increase. During the rate cuts following the 2007 to 2008 financial crisis, gold surged from around $660 to around $1,600, a 140% increase. More recently, in 2019 to 2020, gold rose a third of its value, going from $1,400 to $1,900 due to the economic slowdown in the U.S., trade tensions with China, and the COVID-19 pandemic. Fourth reason: weak investor demand. Interestingly, demand for gold from private and professional investors has been relatively weak, which could be another reason to believe that gold prices have room to rise. According to a Bank of America survey in 2023, 71% of investment advisors had less than 1% of their portfolio invested in gold, and another 27% held between 1% and 5%. This indicates that gold is underrepresented in investors' portfolios, which is reflected in the development of gold ETF holdings in North America and Europe. Although global gold ETFs have shown inflows in recent months, these are far from reaching the peaks observed during the COVID-19 pandemic in 2020 or at the start of the war in Ukraine in 2022. ETF holdings in North America and Europe have enormous growth potential, especially if investors start increasing their gold positions as economic and geopolitical uncertainty continues to rise. Fifth reason, geopolitics. The current geopolitical environment is the fifth reason why gold has room to keep rising. The war in Ukraine, which has now lasted more than 2.5 years, and the escalating tensions in the Middle East, particularly regarding Israel's attacks and the invasion of Lebanon, are factors that continue to generate global instability. This instability is reflected in central banks' balance sheets, which have increased their gold purchases since 2009, leading to the precious metal surpassing the euro as the second largest reserve in central bank assets, second only to the US dollar. Stoeferle mentions that gold's role as a neutral safe haven asset could receive an additional boost at the upcoming BRICS summit to be held in Kazan, Russia, in October. This summit could mark a turning point in the trend of countries moving away from the US dollar, benefiting gold as a safer and more reliable alternative in times of crisis. Additionally, the recent 2024 World Gold Council survey revealed that 66% of central banks expect the proportion of gold in their reserves to increase in the next 5 years, a significantly higher figure than the 46% recorded in 2022. This increase in demand from central banks underscores gold's importance as a safe haven asset, especially in a context of geopolitical and economic uncertainty. In summary, the price of gold shows strong potential for continued growth, backed by several key factors. First, when adjusted for inflation, gold has room to reach new highs. The sustained demand from central banks further solidifies its role as a safe haven asset amid economic uncertainty. Additionally, recent interest rate cuts by the U.S. Federal Reserve could provide a significant boost to gold prices, making it more attractive to investors. Moreover, the relatively low investment in gold among private and professional investors indicates that there is substantial growth potential as they recognize its value. Finally, the current geopolitical climate makes gold an appealing option for safeguarding assets. According to Incrementum's forecast, gold could reach $4,800 per ounce by 2030, a projection that may prove conservative given the ongoing trends. Thank you for watching. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and share your thoughts in the comments below. I'd love to hear your perspective on the gold market. Let's stay informed together. Until next time, take care.